And Alicia Levine is head of equities and capital market advisory at BNY Mellon Investment Management, and she joins me live. Alicia, great to see you.
Hey, Allison, how are you?
Doing well. The market doesn't look too great if you're, not in it for the long term because, this sort of came as a shock to many investors, especially when you look at what's been happening. A few weeks ago, it was about inflation and the market overheating. Those were the big fears. Well, now it seems like growth is in question.
Yeah, I think that's a really good point. In addition to the Delta concerns, I think there's some issues on the fundamentals here. They're not terrible for the market, but they're worth watching. And that's really, if you look at 2022 earnings, even as earnings estimates are going up for 2021, those 2022 estimates are really still hanging in there, and they're not moving up in the same way that earnings estimates for 2021 are moving. So I think that's really just reflecting the fact that we're probably at peak growth, particularly here in the US. It's going to roll over to a slower rate of growth. Not that growth will be down, but that will be slower rate. And we've already seen the rotation in the market. The truth of the matter is that most sectors already sold off into correction, and the only reason the S&P index was up so much was because those FANG stocks and those large cap tech stocks were really hanging in there. Today they're getting hit and taking the index with it.
And so inflation suddenly went on the back burner. This is after on Friday the market was laser focused on it after Fed Chair Jay Powell was on Capitol Hill. And I quote, he said, admitting that while inflation feels uncomfortable and feels like it's a bit stickier than some would like, it's still just transitory. That feels like a pivot in his policy here, like he's changing the narrative here. Are we really obviously seeing a reaction to Delta, but are we also seeing a reaction to a possible pivot in strategy from the Fed?
Yeah, it's very interesting. If you listen to business leaders and you listen to conference calls, every conference call and business leaders, if you speak to them, are worried about inflation. The market is not worried about inflation. Academia, not worried about inflation, and the Fed, not particularly worried about inflation. So there is a bit of a dichotomy, and there's a dance going on here. I think it's a little bit premature to say that inflation worries are gone from the market. We do think inflation will be transitory, but it will settle in at a higher rate than the 1.8% that we had in the post-global financial crisis era. It's probably going to be closer to 2.5 to 3% all in. And yes, it'll be stickier longer, and that's something to look out for. The market is pricing in transitory. It is likely to be the case, but there will be some uncomfortable data coming in the next few months for sure.
Yeah, we did see President Biden address inflation today during an appearance on TV, tamping down on inflation fears. He made the case that these price increases are temporary, but the thing is, he's hoping to push an infrastructure package through Congress. So, of course, he's going to say that it's temporary. He doesn't want to cause any concern.
Yeah, look, I mean, the inflation concern is definitely something on the minds of Congress as they look to spend more money. But I think ultimately we think that the reconciliation bill will probably go through, maybe not up 3.5 trillion, something closer to 2.2 trillion, but with that will come taxes of about 1.5 trillion. I think that's another thing that's being priced into the market here, because 2022 earnings will have to be shaved by about 7% if the taxes as proposed go through, which is that 25% corporate tax rate plus the overseas corporate tax rate, which doesn't get talked about, but actually raises more money than the statutory rate of 25%. So that's what the market's reacting to. Slowing of growth, still growth, but slowing, and somewhat higher inflation, even if it's temporary. Mild stagflation, nothing like the 70s. Let's be very clear. We are not entering the 70s, but just a little of the euphoria of growth is coming out of the market. In addition, the labor market clearly has a supply problem, and we are going to see higher wages, and we will see higher housing prices. All that will contribute to inflation.
So you say no worry about stagflation, but what is the 10-year Treasury yield telling us? Its slide is really jaw-dropping, especially today. What is the bond market telling us about the state of the U.S. economy?
So the bond market is telling us that growth is slowing, that we're in the middle of peak everything. The second quarter was the peak of everything, peak growth, peak spending, peak fiscal. Let's talk about fiscal. We're spending $1.2 trillion through September 1st in 2021, even as the economy reopens. We're not getting anything near that. Even if we pass a $2 or $3 trillion fiscal plan, that's going to be spread over 8 to 10 years. So we have a bit of a fiscal cliff here. And that's what the bond market's telling you. It just has to slow down. Again, I don't think this is fatal. In a normal year, the average drawdown in the S&P is 14%. We're at 3.5% from the high. The most we had in 2021 is a drawdown of 4%. So we are due, I mean, to what Matt was talking about before me, it is not unusual to see drawdowns of this nature. It is unpleasant. If you're fully invested, it's not a pretty day. But I think the cyclical recovery is still here. And I would get out my shopping list in the next few days because I think it's time to start shopping for stocks.
Yeah, and if you're going to do that, you better have a strong stomach. Alicia Levine, thanks so much for coming on the show today.
Thanks, Allison. Really nice to see you.
Good to see you too.